Hello everyone and welcome to January's ACEC RT Financial Wellness Webinar Series, where we'll be discussing the differences between a Roth and a 401k retirement plan. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on your webinar menu. And third, this webinar is set up to be interactive through the use of polling questions throughout the presentation. We encourage you to participate as the questions arise. At the end, we will take some time to go through the questions you've submitted throughout today's webinar. And now I'd like to introduce our guest speaker of PensionMark, Devin Duex. Mrs. Duex is the Vice President of Client Relations at PensionMark Financial Group and has over 10 years of experience. She oversees the national service platform for PensionMark, designs compliance management policies, and travels frequently across the nation speaking to clients, participants, and industry professionals about various retirement plan topics. And with that, I'll turn it over to you, Devin.
Thank you very much, and thanks everyone for joining today. As Tori mentioned, we're going to be going through really about a 20 or so minute presentation on Roth versus your traditional tax-deferred 401k and what the differences are, what the similarities are, and hopefully give you guys some insight into those different provisions inside the plan. If you have any questions, I'm just going to reiterate this, please put those questions in the chat bar. We'll have time at the end for questions. And if there's something that you think about after the webinar has completed, you can always contact us on an ongoing basis, and I'll give you that information towards the end of the presentation. So before we get into Roth and really talking about that specifically, I just want to mention, what is the traditional tax-deferred arrangement? And this might be a refresher for a lot of you that are already contributing, but as a reminder, your tax-deferred mechanism under the 401k is really what we consider to be, your typical 401k plan. You put in money into the plan, it goes in tax-deferred, and so you're not paying the taxes on that money today. The Roth is the opposite of that. It's actually an option inside the plan if elected inside your plan document, which would allow you to put money into the plan after tax. So you've paid the taxes, you put the money into the plan, and there are some considerations and some benefits around that mechanism inside the plan. Now, one thing I will mention to everyone on the webinar is that the Roth may or may not be appropriate for you, just depending on your goals and objectives, where you are in the retirement planning spectrum, what you're expecting to get out of your retirement, your income, goals, objectives, things like that. So we're going to walk through all of that together today, and hopefully by the end you'll just have a little bit more understanding of what the feature is and maybe how to consider that in your retirement planning approach. So moving into the next slide, we're going to talk about just what Roth is. So again, as I mentioned, it is after-tax contributions. They go into the plan after you've paid all your taxes. If you stay in the plan, this is a very important thing, you have to stay in the plan at least 5 years, and then you must be 59 and a half, and at that point when you take out your money, the money comes out tax-free. Now, one thing I will mention, anything you do put into the plan up until any basis, what we call our basis contribution, so let's just say you defer $5,000 after tax, that basis contribution is always going to be a tax-free withdrawal. What we're talking about is the earnings. So in your typical traditional 401k environment where you do pre-tax, everything is tax-deferred. Your earnings are tax-deferred, your contributions go in tax-deferred, and the difference is on the distribution you pay the taxes later. In the Roth environment, you're putting the money in after tax, the earnings are growing tax-deferred, but if you get to retirement and you haven't been in the plan for 5 years or you retire before 59 and a half, you wouldn't get a tax-free withdrawal on the earnings. So that's really what we're talking about when we talk about a qualified distribution. So very important to note. And one other consideration, and we'll talk about this a little bit later in more detail, is if you are rolling the money out of the plan at some point into a Roth IRA, the Roth IRA also has a 5-year time frame on it as well. So each plan, you have to meet a 5-year window that you've been participating and be 59.5 to reach a qualified distribution. So we'll talk about that in a second. The next feature is it's really similar to that of a Roth IRA. And if we can just go back one slide and just, there's a couple more points on there we want to get to. It's really similar to a Roth IRA. The difference is under the Roth 401k, you don't have limitation, or I should say rather eligibility based on income. So in the Roth IRA environment, you're eligible to participate in a Roth IRA dependent upon your income. As you make more money, or if you file joint with your spouse or significant other, that income is treated together as joint filer, and there is an income limitation, and at some point the Roth IRA isn't applicable to you. And so that's very important to note, because in the Roth 401k there isn't any eligibility requirement. If it's a feature inside your plan, you have every opportunity to use it as a provision, and you can make contributions to the after-tax bucket at any time regardless of income. The other 2 points that we're going to go through right here is that it's really inside the plan, it's really everything else is kind of status quo. So the only difference is really the tax treatment. You get the same menu of investment funds, you get the same loan features if loans are allowed. Sometimes it's good though to check with your plan administrator to make sure that the after-tax is included in that. They can switch that on and off just depending on the plan document. But everything else is really status quo. You can look at your account online, you get the same statements. One other thing I will mention is the amount of money that you can contribute into the Roth bucket. It's an aggregate number between both types of tax treatment. So what that means is your limitations for the year, so for 2016 it's $18,000. And if you're 50 years of age or more, you can actually do an additional $6,000 on top of that. That limit is a total between any money you put into the plan. So any money meaning tax deferred or after tax money. So you don't get an extra bucket of money that you can now contribute. You have to kind of pick and choose between that to equal your $18,000 for the year or an additional $6,000. Okay, so hopefully that makes sense. So moving into the next, we're going to go through some of the benefits of this and some of the considerations that you might want to think about. So some of the benefits of contributing after tax, while you're paying the tax now and you're sort of locking in the tax rates that you have currently, if you have expectation that tax rates will rise in the future, and again, depending on where you are, that's a really difficult question to answer. If you're 30 years away from retiring, it might be really hard to predict what are tax rates going to look like. Tax rates historically, if we go back in time, they go up and down. They're cyclical. They're not a trend you can predict though, but they do move around and they're not always consistent. So we're definitely in an environment where tax rates are somewhat compressed. There is anticipation that tax rates could potentially rise. Again, depending on where you are in the spectrum, if you're retiring in the next couple of years, you probably can have some sort of comfort with maybe where tax rates are going to be. Again, if you're 30 years away, if you're early on in your career, tax rates they could have gone up and come down again in that 30-year time frame. So that's a little bit of a more philosophical discussion around, what you think predicting tax rates could be. Longer career, if you're starting out right now and you're in the earlier parts of your career and you expect to start making a lot more money, after tax contributions could potentially be something you consider as you get further into your career. Lower taxes on Social Security benefits or estate planning if you're looking to have ways of passing money on to heirs, or having some sort of having different tax buckets to choose from in retirement, that gives you that ability as well. Some considerations though around after-tax money going into the plan. I think the number one consideration that most people want to think about is really how much you're contributing to the plan. So let me break this down. If you're contributing $10,000 tax deferred and you're considering contributing after tax, and you can only contribute, let's say, $7,000 because you're paying the tax, right? And so that's going to reduce the amount of money you can then contribute afterward. A lot of times you may, even at the end of the day, after you pay all the taxes in the pre-tax environment, you could still come out ahead with the growth of the money over time because you've contributed $3,000 per year more on average, right? So what I would really highly encourage you to do is, if you are considering this after we go through all of this information, really look at your situation. Really look at what that would mean for you. If contributing to the Roth really significantly reduces your contribution, you may still want to consider tax deferred because, again, the amount of money you put in compounded over time with earnings could exceed what you're doing under the Roth bucket even after you pay the taxes. And again, that's going to be case by case. Every individual is going to be different, but I would encourage you to really take a hard look at that. Rather, there's a lot of different factors to consider than just some of the benefits that are under the Roth feature. So moving into the next slide, we're actually going to ask our first poll question. And so I would encourage you guys to answer that because it's going to really help us move this dialogue around. But what type of retirement accounts do you currently have? Do you have a 401k tax deferred? Are you participating in that? Do you use a Roth? And it could be Roth IRA or Roth 401k. That's completely fine either way. Or do you use both? And we'll just wait a couple of seconds here to get the answers. All right, so it looks like we actually have quite a few people that are using both, which is great to know and understand. And then we have a little less than half of our participants on the call today using the tax deferred. So great, that's really great to understand, and I appreciate you guys taking the time. We have another poll question right after this. What type of, are distributions of Roth accounts subject to taxation? So for those of you using that Roth bucket, hopefully you have a good idea. All right. So distributions to Roth accounts subject to taxation, majority of you said no, a little bit of you said yes, and 23% I don't know. So let me answer that for you as we move into the next slide. Roth accounts, generally speaking, if you've reached the quote-unquote qualified distribution stage of the Roth savings, it is not subject to taxation. Because you've put the money in and you've already paid the taxes, as long as you've been in the account for 5 years or more and you're 59.5 years of age, or death or disability, you would be deemed a qualified distribution and therefore not subject to tax. The caveat to that is we sort of tiptoed into early in the presentation. If you haven't been in the account for 5 years, or you are not taking a distribution and you're 59.5 yet, maybe you're 55, you would not be deemed a qualified distribution and your earnings would be considered for taxation. So when you go to do your taxes at the end of the year, your earnings would be counted as gross income and therefore subject to taxation. So very good on that. A lot of you got that right. A couple of other things between the Roth and the traditional, you'll see a lot of things are very similar. The main difference is obviously the taxation going in and out of the plan. So Roth, again, being after-tax contributions, traditional being tax deferred, going in, taxes on the way out. Both accounts grow tax deferred. So that's, a win-win for either scenario, again, which is why I mentioned one big consideration is your savings rate. If you are significantly reducing how much you're saving by doing Roth, even paying the tax later in the traditional environment, you still could come out ahead because you've been compounding on a larger balance over time. So definitely an exercise to go through, and I can talk about some ways that you can do that further in the presentation. Under the next bucket, we talked about distributions. So again, traditional, always taxed on the way out. There's no way around that. You've never paid the taxes in the first place. You're always going to pay it on the way out. And then the Roth feature, again, as long as it's a qualified distribution, no tax on the distribution. Now, I mentioned earlier in the discussion that Roth 401k does have the ability to be rolled to a Roth IRA. So let's just say you're working for your company and you're retiring and you decide, you know, I don't want to start taking distributions. I actually want to, you know, keep it in the plan. You could keep it in the Roth 401k account, or you could roll it to a Roth IRA. And in doing that transaction, if the Roth IRA is opening for the first time, you haven't had the Roth IRA open before that, the clock will start again on that 5-year window on the Roth IRA. So one consideration for those of you currently using the Roth bucket, if you don't have a Roth IRA, you may want to consider opening one to get the time clock going so that you're not waiting another 5 years come your retirement. So that's just a consideration I'll throw out there for those of you. Now, some of you, again, depending on your income, may or may not be eligible to open a Roth IRA. So again, that's just another piece of conversation for your financial planning dialogue. The next item, the required minimum distributions, this is where it's very similar. Under the Roth 401k, different than Roth IRA, you do need to start taking required minimum distributions if you were to leave the money in the plan and you turn 70 and a half. So how to avoid that? If you're doing Roth 401k, roll it to a Roth IRA. Roth IRAs are not subject to the required minimum distribution provision because you're outside of the company-sponsored retirement plan. So by allowing you to do after-tax under the 401k, you know, umbrella, you're essentially taking on the provision of some of those parts of the traditional 401k, one being the required minimum distribution. The final piece is the match. If your company offers a match or your company offers some sort of contribution, are you eligible for that if you're doing Roth 401k? Yes, you are eligible for that. One consideration or one piece to remember is that typically your match is done in tax-deferred dollars. So you're going to see that accounted for on your statement. For those of you that are currently using this bucket, if you have a match going on under your plan, you're probably seeing that on your statement. So that employer match is going into your account, but it's going in with tax-deferred dollars. So on the distribution side, you will have taxes for those monies as you take them out. So moving on to our next polling question. Can I roll money from a Roth account into a 401k account? So rolling money from a Roth account, so Roth IRA, into a 401k account. And there's a lot of new rules that have come out around this, particularly inside the plan. Can you change money types inside the plan? But let's just see how familiar we are with rolling money from a Roth into a 401k. So 17% say yes, 25% no, and 58% I don't know. So really good temperature here for the answer of the question. It's kind of a tricky question because you can actually roll it in, but you have to have the Roth feature inside the 401k. So you can definitely roll a Roth IRA into a 401k, but it has to have a Roth 401k bucket. So if your plan has that, you can definitely, you know, move that in or out. You can convert money inside of the plan also from pre-tax to after-tax if you want, if the feature is available inside the plan. Again, there's a lot of considerations around that. If that's something that's available and you're considering that, I would encourage you to call the Financial Wellness Help Center and talk about that, because there's a lot of things that you need to be aware of, such as you've got to file that as tax income for the year. You've got a lot of considerations around doing that. So, but I want to just take a second here and talk about the three side by side. So we've got traditional 401k, Roth 401k, and Roth IRA. So we've already kind of looked at traditional and Roth just in some general terms. but getting more into some of the details. So again, contributions for traditional pre-tax, Roth 401k, Roth IRA, the same after tax. Investment earnings, so all of our investment earnings in the traditional 401k is tax deferred, but we do pay taxes later because, again, we've never paid tax on that money when it went in. The Roth 401k and the Roth IRA, investment earnings, again, this is a repeat. We talked about this earlier, but they're tax-free or no tax as long as it's qualified. Again, so as long as it's you've been in the plan 5 years and reached 59 and a half years of age. Matching, we already talked about this in the last slide, but yes, you can get matching in both your traditional and your Roth 401k, not in a Roth IRA, and that makes sense, right? Because a Roth IRA is an individually sponsored plan. So you'd be essentially matching yourself, and so therefore there's no such thing as matching in a Roth IRA. You'd just be making contributions on your own behalf. The 2016 limits, so the biggest difference, again, we talked about the traditional and the Roth, but the biggest benefit, I'd say, of using the Roth 401k, if it's available in your plan, is that you can contribute a lot more than you can outside of the plan on your own. So $5,500 under the Roth IRA for 2016, $6,500 if over the age of 50, much significantly increased to $18,000 under the Roth 401k umbrella or under your traditional 401k umbrella. So you get a much bigger opportunity to contribute for yourself. Again, whether you're using tax deferred or after tax, using your company-sponsored plan, again, gives you a lot more opportunity to save for your retirement. There are not income restrictions inside your company-sponsored plan, whether you're doing the Roth 401k or traditional, but you do have those income restrictions in the Roth IRA, and that was something we talked about earlier in the webinar. For married couples or joint filers, $184,000 is where you cap out and you're not eligible for that Roth IRA. For if you're single and you're filing a single filer, $117,000 is where you cap out. And there are some incremental thresholds as well, but this is just wanted to show you the caps, at least where it caps out. So if you're in those ranges or above, you're not eligible for the Roth IRA. And so if you were ever considering an after-tax mechanism to save for retirement, if that seems to make sense, after you go through some exercises to sort of figure that out, the Roth 401k may be a feature you want to consider. And then taxes paid, again, we talked about this. This is sort of, some of this is repeat. When the money is withdrawn, when contributed on both the Roth 401k and IRA. Your access to money is very similar between the different plans, but the traditional upon leaving your job or disability or death, subject to the same rules under the Roth 401k. So really business as usual for a lot of the other provisions for the Roth 401k. The main difference is going to be your taxation. And then we talked about some of the minimum required distribution options and then rollovers. So this is a piece that we get a lot of questions on in our call center. If I have a traditional, where can I roll it? For traditional, as long as it's the same tax treatment, you could typically roll it, to another 401k or a traditional IRA. You have a lot of ability to move that money around upon distribution. For the Roth 401k, similar answer, it just has to have the same tax treatment. So if you want to roll your Roth 401k to your new company, let's say you move companies, they just need to have the Roth 401k inside their plan, and you can move that over to that new account. If they don't have that, moving it to a Roth IRA would be the option you would consider. And then for the Roth IRA, just you can only go from one Roth IRA to the other, or in to the 401k as well. So moving on to our next slide. We've got our fourth polling question. So we've gone through a lot of information. Hopefully some of this helps you maybe gauge this question and get your answer. But what key factors are important to consider when contributing to a Roth account? what key factors are important to consider when contributing to a Roth account. We'll give it one more second. So we've got 15% your income, 8% your retirement age, 15% your tax bracket, and 92% all of the above. So great job. I don't think there's any right or wrong answer, but definitely you want to consider as many things as possible. And if you could move to the next slide, we actually have some of those things laid out, so you can just take a peek at that while I'm discussing it. But really, when you're looking at how to contribute to the plan, I mean, the most important decision is contributing in the first place. We want to make sure you have money going in and you're saving for retirement so that you have that account growing over time. Then the question is, do I do the Roth or I do the after tax? And you definitely want to consider a lot of these different considerations: your age, your expected retirement date, your income. Are you in the earlier parts? Are you making a lot of money and you can't do a Roth IRA, and you want to be able to sort of reduce on the tax you're paying in the future, your current tax bracket, expected financial needs in retirement. So if you're going to actually take more money out when you're retired or need less money, that's a question you'd want to figure out, because if you're going to need less money in retirement, which is pretty traditional when we look at retirement, most individuals take and use less money in retirement than they do currently, because in your current accumulation stage, is what we would call it, when you're building your asset, you're usually in the phase of maybe you've purchased a home, or you're building assets under your financial picture, and so you're paying a lot more out today than you might need later in the future. And so if that's the case, you may not pay as much in taxes down the road, and therefore tax deferred may be the option that works for you. If you expect to take out a lot more money in retirement and you plan to save a bunch to do that, then maybe after tax may be a consideration that may factor in. So these are all very important. Again, the one that's not on here that I would encourage you to take a hard look at is really your savings rate. If, again, your savings rate is compromised by doing the Roth feature, again, you may come out ahead by doing tax deferred, because you are able to contribute more over a longer period of time, and even after paying tax, you come out ahead. So again, that's just something to factor in as well. There's several different calculators that you can look at. There's resources on the ACECRT.com site. There's also resources on the ACECRTplan.com site, which is the Empower site. And you can run some calculations to see what your after-tax, what your paycheck would look like if you do different contributions. There's calculators to run projections to see if I did Roth versus pre-tax, how it would come out if you do a expected rate of return over time. So there's ways to kind of do some exercises to understand what might be a benefit for you. Also, you can do a combination. So you can do after-tax and tax deferred. So for some of you that want to have some after-tax growth happening under your 401k account, but you don't think it's beneficial to do all of it that way, or maybe after you run the analysis, it makes sense to do some, but a majority under tax deferred, you have that ability as well. So it's not an all or none, it's a combination that you can use in any manner that is in the best interest of your overall plan. So again, you just want to factor it in and take some time to really think through it before just checking the box and writing a number down. Once you've done it, though, for those of you that are using this, you probably can attest to this, but your contributions appear on your statement just like your current tax-deferred contributions. They're itemized out separately because, again, it is a different, quote-unquote bucket of money that has a different tax treatment. You can also get details under your account detail section or your transaction summary. You can see that happening on your account pretty much day to day on the ACECRTplan.com site. For further information or help or wanting to run some of these projections, just a reminder that you have the Financial Wellness Help Center. That's part of the Financial Wellness Program that's available to you through the ACEC RT Trust. And those numbers are there on the screen, and you can contact the Financial Wellness Help Center anytime, Monday through Friday. You can send emails on the weekend, and we'll definitely get back to you during the week. But feel free to contact the Wellness Help Center. That's what they're there for. They're registered representatives that are specialists in this arena. All we do is retirement planning, and so we can definitely help you with any of these questions or other questions related to your account. So before we wrap it up and go into some questions, I just wanted to quickly, we're not going to spend a lot of time on these different elements of the Financial Wellness Program, but I just wanted to remind you just briefly some of the features that are available that can help you, again, answer the question about Roth or answer the question about really any question you might have under your retirement plan or retirement planning in general. So those components really encompass a variety of different tools. The Personal Financial Portal is a tool that allows you to put all of your accounts into one spot. You have access to that right now, so if you haven't been using it, all you need to do is sign up for that by sending your email and your name, first and last, and your age, and then we will send you a login, and then in a separate email, a password, and you'll be able to access that account. Through that account, you personally can do a lot of things to understand your overall financial picture. But more specifically related to the Help Center, what the Help Center can do with you is help run a gap analysis. And the gap analysis is really designed to help you understand if you're on track to retire. You know, are you saving enough? Are you going to have a shortfall, a windfall, meaning are you going to have more money or less money? And so when you're looking at things like Roth, and should I add that to my plan, using the Personal Financial Portal and the gap analysis can help you really understand if that's a direction or a feature that might be relevant for you. The other couple of items under the Financial Wellness Program, again, you have the Help Center, and that's staffed with registered representatives who are all licensed to give education around financial planning, retirement plans, investments, and pretty much anything that has to do with retirement planning in general. So feel free to contact them at any time through email or phone. And then you have a series of electronic campaigns that will be coming out through the Retire Connect program, newsletters, quick touch points, and then everything is saved on the Education Center at acecrt.com. So if you miss something, want to access something, see a video, I would encourage you to visit that site as well. And then if you like social media and want to stay up to date, that's another way that you can do that as well. So I'm going to wrap it up there and turn it back over to Tori for questions and Q&A.
Great. Thank you so much, Devin. We'll now start addressing some of the questions that have been filtering in. And please remember that if you have any questions, you can submit them using the Q&A tool on your webinar menu. And as always, you can reach out to ACEC RT's Financial Wellness Help Center for any plan-specific questions. And that information is up on the screen for you. Our first question, can I contribute in an employer 401k and or Roth and still contribute to an individual Roth IRA?
Yeah, the answer is yes. You're definitely eligible to contribute to the Roth IRA as long as you're eligible to participate in the Roth IRA. So that's the one caveat. If you're eligible to participate, you're not limited by income, you can contribute to a Roth IRA. That's different than the traditional IRA. Because you're paying the tax already on the Roth IRA, you're able to do both. If you were talking about doing a traditional IRA and participating in your employer-sponsored plan, typically the answer would be, yes, you can still do it, but you may not get the tax benefit in the traditional IRA. So you get a little bit of a buffer or a little bit more flexibility when you're paying your tax already, because the IRS is not concerned because you've already taken care of your tax liability for the year. So hopefully that answers the question. But yes, you can definitely contribute to your employer-sponsored plan and then have a Roth IRA on the outside.
Thank you, Devin. Our next question, can I change my mind and have designated Roth contributions treated as pre-tax elective contributions?
So the question was, if I have Roth contributions that I've started putting in the plan, can I now make them tax deferred? And the answer to that is, unfortunately, no. We can't go backward once you pay the tax. You can convert from tax deferred to Roth, where you're deciding to pay the tax and then make it a Roth account. But once you paid the tax, really can't go back and amend your tax filing, go back to the government, ask them for your taxes back. So that's a little bit, unfortunately, once you've done that, it's got to stay Roth.
Great, thank you, Devin. It doesn't appear that we have any more questions, so this will conclude our webinar session today. Thank you again, Devin, and thank you, attendees, for your participation. I hope everyone has a great day, and we look forward to our next webinar series with you. Take care.